Banks around the world are preparing for a massive crash. So here's an article from the Financial Times about the credit contraction around the world and how the banks are responding, how it's affecting the businesses. This will explain the credit contraction cycle that I keep mentioning in a ton of my videos. And there's not really a single place you can go just to see like, oh, here's the whole credit contraction. It's a bunch of different little pieces of data from all over the place that put this together. But but the financial reports for a bunch of the international banks are coming out in the next couple of weeks, and the first ones just started coming out, and that's what this article is about. And it's talking about the governments and the banks and these quarterly reports that come out, and businesses can't get money, and we're going to see exactly what's going on here. This is Brian Lewis with MMT Investing, and things just changed. So one of my subscribers, Ellie ET, uh, the real ET, like hits the smash the like button to help me out with the YouTube algorithm. So this is the Financial Times, and it says Bank of England warns that bank loan reserves risk choking business funding. So banks can't lend right now, and the government's trying to help. And regulators fear conservative planning for defaults will restrict much needed credit to companies. So the regulations, the basic rules that are on right now, um, are not going to allow businesses to loan. They're going to have to change things in order to keep businesses getting money. And it says Britain's financial supervisors have relaxed the capital and audit rules, just bending the rules to ensure lenders do not eat too far into their loss absorbing buffers. So they have liquidity that they can use when people go default, and uh, the government is bending the rules to get them more money for defaults because there's a lot of defaults coming right now. And this is what the contraction is all about. All the debt that's out is overextended, and people can't pay on it, and the banks can't keep lending. And the contraction is when people are paying back their debts or defaulting on them and not taking out new ones. And you see the credit standards start to change. And this is happening all over the place. But this article is focusing on the European banks. And Bank of England is a really good one because they're just really forthright and pretty open about their monetary policies. And I've covered Bank of England. I think I did a whole specific Bank of England video before, but Bank of England is really good. Like, if you can go to the Bank of England website, like they explain their monetary policies. They have little how-to videos about money printing and the targets and all kinds of stuff. Things that the Fed is doesn't really talk about that much. The Bank of England is really open about it, and so the the representatives from Bank of England authority have spoken with the top banking execs and advised them not to kitchen sink provisions in the first year, in the first quarter of the year. Um, so so there's a huge risk, and the Bank of England is trying to help the banks stay solvent and continue to be able to loan money. Okay, so the Bank of England Prudential Regulation Authority, the PRA, is concerned after seeing these numbers that have been posted, big increases in reserves for defaults. So the liquidity held to the side just for people defaulting to deal with the defaults is going up, and the U.S. lenders have already posted their stuff, and it's 24 billion, a year-on-year rise of 350% in this fund for defaults, and Bank of England is getting really scared. And then Credit Suisse is the only European bank that has reported so far, and Credit Suisse has reported a 600% increase in their default funds. And then like Barclays, HSBC, Lloyds, RBS are reporting over the next 2 weeks. It doesn't mention Deutsche Bank, which is a massive one that's like at the center of the EU. Um, and if they were to increase at the same level, uh, they would suffer sharp hits to profits, and yeah, Barclays would likely fall to a loss. So this is really serious for the banking industry when they're getting all of these defaults, and this is why you see all the banks now are tightening all their credit, their risk management, where you have to have a higher and higher credit score to get any kind of loans, and they're just trying to work with people to try to get people to pay, and all this magical money, uh, billions and billions of dollars, 350% increases in these funding accounts, and 600% is what we're seeing in the European banks so far. And where are these billions of dollars coming from that they had this like in their back pocket and they're just holding it for a rainy day, and now seems like a good time to just like for it to just show up in their accounts, all this liquidity. Like I have one guess as to where that money might have come from, and it has something to do with the Fed's balance sheet bumping up by $1 trillion or $2 trillion here, and in the past month or so, and the Fed opening a brand new repo market to service these international banks and try to get liquidity to them. That's what I've been talking about for a while. So it says more important from the regulator's perspective is that such conservative planning for defaults will hit the capital levels, reducing the bank's ability to write new loans at a time when companies desperately need credit. So this is the situation that we're talking about where banks can't lend. They can't lend, and there's loans due, and people are defaulting. And this is what a credit contraction is, as when banks cannot lend and there's defaults, and you have money being destroyed out of the system. That's a contraction. And the Bank of England has already relaxed audit rules, and they're trying to make it easier for banks to lend. But there's limits on this. Unless there's a significant increase, it won't be credible. So they're looking to go big here. But they can't be so massive that they absorb all the capital relief. It's not realistic. They're just saying, like, we have to do a lot, but it's scary. We don't know how much to do. Sensible, cautious, don't go overboard. So they're debating the international accounting rules, the IFRS 9, about how they have to immediately book deprovisions when the debt goes bad, and they're trying to do easier lending rules so that banks can lend when they shouldn't. Um, and they're looking at the GDP here. So 6.5% decline in the British GDP is what the IMF projected. And I looked at the IMF projections in a previous video here and mentioned that they're usually not the best, but it's interesting to see what they say. Whereas the UK office themselves is estimating a 13% decline in GDP. So yeah, it says Credit Suisse again here increased the bad loan reserves sevenfold to 583 million. And Italy also, we have their financial stuff. Unicredit set aside 900 million euros, which is a bigger increase, whatever that is, like 11 or 12%. And this is because the two use dramatically different economic forecasts, and the Swiss lender sees the Eurozone falling maybe 5%, and Italy is bracing for more than double that rate. So this is how the banks are preparing for a bunch of loans to go bad and the financials to be in a really bad spot where they can't lend, and the government officials are doing whatever they can within the limits of the international system and just basic economics for banks just being able to lend in this kind of situation when you're in a major credit contraction. So they're going to be working on this, and the contraction is going to be happening, and it looks like it'll be happening out into June sometime, and then we'll hit the end of this contraction cycle when they can actually start lending again. And we'll be forecasting this on the stock charts, and um, so you can see all these different things. This is an international dollar system. It's the euro dollar, the worldwide banking system that isn't a huge credit contraction. It's the entire world system, and it's hitting these European banks really hard. But it's hitting America too, and you can see it in, if you look at these banks in Europe and the governments, what they're doing now to prepare. And I should do a video on Jerome Powell. So Jerome Powell just announced that he's going to start buying junk bonds, which is a new thing. Like they were already preparing to buy the investment grade corporate bonds, and they started doing it, but mostly what they did was announce that they're going to start buying bonds, and then everyone kind of chilled out and the bond market went up, and they didn't really have to buy that many bonds because the market bought a bunch of the bonds. And now they're preparing to buy a bunch more bonds, and this is going to include, they call them angel, like fallen angels or something like that. And it's the bonds that used to be investment grade, but they've been downgraded into the junk bond status. And that it's the top tier of the junk bonds. And the Fed is adding those to corporate bonds that they are going to be open to buying anytime soon. And people are calling them out as bluffing, like they're just saying they're going to buy bonds to try to get everyone else to buy the bonds and sort of do their job for them. Like Jeff Snyder talks about that all the time, how they just like use psychology to get the market to do what they want. Um, but Powell is like, we're not joking around. Like, we're going to start buying bonds soon. And what would be the condition where they needed to do that would be when these companies are about to go bankrupt, and that is basically bailouts and stock buybacks have both become bad words. And so they're not going to be doing bailouts. They're going to be buying a bunch of corporate bonds to give liquidity to the companies. And that frees up liquidity for private credit to be issued. And it's sort of a bailout without calling it a bailout or directly doing a bailout from the Fed. That's going to be their first line of liquidity is going to be these is going to be the corporate bond buying, and then as it progresses, we'll see if they get into bailouts or start actually buying stocks, which they're not supposed to do. So that's what the Fed is doing. This is what the banks in Europe are doing. The European banks are freaking out and stockpiling money for a bunch of defaults, and the European governments are changing all the rules to try to deal with the situation. And then you can see this through a bunch of the other markets too. I mentioned LA a couple of times because they have a huge section of their housing market that is the jumbo housing loans. And those jumbo housing loans have been completely cut off. You can't get those loans anymore. So, like, those loans are disappearing, and the credit card companies are changing their credit limits and their credit amounts. You have to have higher and higher credit score to be able to get cards and to get loans, to get mortgages. Mortgages are a little bit behind most of the other credit contraction stuff. Mortgages usually cycle a little bit later, and it takes several years for the housing to decline. It's just a slower market, but you can see the credit contractions already happening in housing, which is concerning. And this is just the basics of the credit contraction cycle. I mean, we have sort of a long-term outlook for a long-term cycle. This is the backside of a bubble. So the backside of the bubble is a big contraction cycle over, who knows, 2 years or 6 years or something for the bubble to kind of wind down. And that's a slow, kind of gradual credit contraction. But inside of that sort of bear market, a contraction bear market would be a couple cycles where it pulls down aggressively in the short term. And that's what we saw right off the top of the everything bubble. And this cycle is not over yet. So that's why we're tracking on the stock market, trying to figure out when this next leg of the contraction is going to pull down before we get into the next expansion, and try to figure out targets and timing for it. So that's the general idea of the credit contraction. And I think that's probably good. I might go and do another video about the Fed and about Powell and what they're trying to do right now. I looked at the Fed balance sheet in a previous video and showed that they're decreasing their quantitative easing efforts right now. Like, they were doing a ton of quantitative easing, and they started buying corporate bonds while that huge crash was going on, and they've stopped doing everything except They're starting to taper down the quantitative easing now, and that's generally the point at which it's going to turn. The stock market is going to turn over when they stop responding, and they're like, okay, it's good, everything's fine now. We don't need to do, the quantitative easing, and we just make some provisions in the law that allow us to buy junk bonds now in case that's necessary. Like, why would that be necessary unless there's going to be another huge contraction move? So we'll see. We'll see what happens. That's the update. And thanks for sending me this article, Ellie. And yeah, I guess that's good. This is Brian Lewis with MMT Investing. Oh, and I have like a little subscribe button logo thing that's new. Hit that thing and subscribe. And this is not investment advice, educational material, not meant for people to base their trading and investments on. And happy trading.